Hello everyone. In this episode we'll consider the role of cities in economic development. Just an overview of where we're going in the next few minutes, looking first at the patterns of development, or stylized facts as we sometimes like to call them. There's no question that with higher levels of income, higher levels of development, however measured, countries that are more developed are more urbanized, that a higher fraction of the people live in cities or metropolitan areas. The causality here, however, remains unclear. At least it's hard to parse out the different parts. To begin with, there's no question from economic theory and from empirical analysis, cities have the possibility of driving productivity growth, of keeping incomes higher. We'll see that this is because of some efficiency benefits that having economic activity together in one place can bring us. At the same time, it's also the case that higher income countries can afford more cities. Cities are, as we'll see, expensive to run. They're very capital intensive, and they have a lot of consumer benefits. A lot of amenities are possible with cities that simply are not in a diffuse rural area. So that tells us that cities may have some great benefits as countries begin to develop and achieve developed country status. On the other hand, there are many who argue with a fair amount of evidence that developing countries often are, quote, excessively, unquote, urbanized or too rapidly urbanizing given their state of economic development, which is one that's perhaps in some sense not ready to gain the efficiency benefits from urbanizing. And so this is kind of two horns of a dilemma, and this is what suggests the urbanization dilemma of developing countries. And associated with this, as we'll see in the following video, is the question of whether rural to urban migration that has been proceeding so fast in Asia and now in Africa as well, is this going too fast? And what would the implications of that be? What would indeed drive it? So first on the stylized facts, perhaps not a beautiful diagram, but it gets the idea across. On the x-axis we have the log of per capita GDP in the year 2020. And on the y-axis we have the percentage of people living in urban areas in 2010. And you can see that there's a very strong positive relationship. It's unmistakable. Each dot is one country. And you can see also that there's a lot of variability, but nonetheless, the correlation is clear. Here's another look, a figure from the textbook. Here we have two observations. First is the linear fit in the data that we just saw. It happens to be an ordinary least squares regression, just one way of finding a best fit of the data. And we're comparing this now with the best fit that took place if you use the data that are available from 1960. And there's no doubt here that there is a shift up, a significant shift up in the degree of urbanization at any given level of income. It's hard to know exactly what to make of this in and of itself. Perhaps technology has changed in some ways, but it also may be that some of the countries that are rapidly urbanizing now may not have the same efficiency benefits from having done so as in the past. Most strikingly, perhaps, is that in the 19th century, when most of today's advanced countries were developing, they were urbanizing at the same time as they were industrializing. That is to say, development of cities and development of industry in those cities went hand in hand. On the other hand, in many low and lower middle income countries, there's been rapid urbanization without industrialization occurring at the same time. And associated with this, we have a figure that I think is of some interest. Someday, perhaps this data will be more brought up to date, but the picture nonetheless still is found. Basically, we have here two observations of the same country. Each of these line segments represents one country. The circle represents the data from 1970. The diamond, the data from 1995, a quarter century later. At the end of this quarter century period, from about 1982 to 1995 in Africa, we had the ongoing debt crisis. And through the 80s, 82 to 89 or so, the debt crisis in Latin America was also quite severe. Once again, we have gross domestic product per capita on the x-axis, and the share of urban population in total population on the y-axis. And I think that what you can find that's quite striking here is that in all cases over this 25-year period, the urbanization rate, the percentage of people living in cities in these countries rose. And so the original caption of this analysis, that was a World Bank publication, said that as countries develop and incomes grow, the rates of urbanization increase. But what's striking here is that there are a number of cases in which actually we had over a quarter century a shrinking of the economy, a shrinking of output per person. No recession here, in the sense that we're talking about a quarter of a century. And in even these cases, such as these two, which are quite prominent, but you'll see a couple of others if you look at the data, even in these cases in which income is shrinking over this quarter century, the fraction of people living in cities was increasing. And so this tells us that we need to look a little more deeply at the question of whether urbanization is always proceeding at just the right speed for economic development. Here's a picture of an urban area in a developing country. If you've been to one, you'll find them fascinating places. Again, taking a look at some of the projections, urbanization is occurring rapidly and continues to occur rapidly, as it has done so not so long ago in the case of China. This is now happening very rapidly in the rest of South Asia and in Africa, to the point where by 2050 it's expected that the rural population will actually start declining even in developing regions, while at the same time total population is growing. And the unmistakable trend is that the population around the world, but also in developing countries, will be focused on cities. Right around now is a time in which there are going to be more people living in cities in developing countries than rural areas. That threshold was passed a few years ago for the world as a whole. So if we see that cities are associated with high-income countries, associated with high levels of development, we want to look at that more closely. We want to get a sense of what the economic advantages of concentration of economic activity would be. And the answer that economists have arrived at through research is agglomeration economies, as we call it. That is to say, in two parts. There's urbanization economies. These are general economies that are gained from all economic activities of different types concentrated together, but also localization economies, and these have to do with the benefits of activities of a specific economic sector or activity being together, such as the auto industry. And some of these benefits are saving on transportation, whether it be firm to firm, one firm's output, another firm's input, or from firm to the consumer transportation, much less costly within a city. Another is seeing that firms want to locate near workers who have the skills that they need. At the same time, workers would like to be located in an area in which there are firms that need their skills. And so these two forces together tend to bring more workers with a particular kind of skill and more firms of a certain kind of activity or set of activities that uses those skills together. Firms also benefit from concentrated infrastructure, and an important point here is that it can be very specialized infrastructure that's associated with the kind of work that they do. Also, firms benefit from knowledge spillovers in their industry and related industries. And we looked somewhat at this very question when we examined chapter 4 and looked at the question of complementarities in economic development, including the possible need for a big push. And also, there's an idea that close proximity of many people might increase the rate of innovation more generally. This is actually a suggestion of the Nobel laureate Michael Kramer in a very interesting paper that he had that was titled Economic Growth from 1 million BC to 1990, or paraphrasing the title. Quite an interesting title, but a very interesting paper as well. And then one last point, it is worth mentioning again, another benefit of the city is the urban amenities that consumers benefit from. Along the lines of this question of the economic benefits of firms in a particular sector or activity locating together, we have this notion of industrial districts forming. Industrial districts, a phrase that goes back to Alfred Marshall, who you may know from the supply and demand scissors. Sometimes these are called clusters as well, relating to the work of Michael Porter, Competitive Advantage of Nations. But this clustering is widely viewed as a key to sectoral efficiency, to being efficient in a country in particular kinds of economic activities. Again, car industry might be one example. So industrial districts comprise firms in the same or closely related industries or activities that are clustered together to get profitability enhancing benefits. That is to say, these firms are clustering together voluntarily because it's profitable for them to do so. These districts also can enhance efficiency through knowledge spillovers, learning from what other firms are doing just by talking to people over lunch, maybe peering over to see what's going on, maybe hiring someone from another firm to work in your firm. Maybe you'll benefit from what they learned. There's all sorts of possibilities. These industrial districts also provide some opportunity to contract out work easily when a large order materializes. This makes it possible to take risks of entering, of getting customers. You don't have to worry that you won't be able to satisfy demand. You'll also benefit when other firms have a lot of demand and they can contract out for you or to you. So firms can also benefit from operating in well-established districts for marketing advantages, where potential customers know to go and shop for the best selection. Unfortunately, a lot of developing countries have made very limited progress in this area of having their industrial activities clustered together effectively. China is an example of a country that went from almost no clustering when its modern economic development experience began around 1980 until in this century being one of the most interesting examples of clustering that you can find in the world. So we should think about then efficient urban scale, because it does not follow from anything that I've said or we've considered so far that we would want to indefinitely urbanize. For example, it doesn't mean that all the people of a country would most efficiently come together in one city. So we have to also think, on the one hand, there are benefits, some efficiencies, but there are also some costs on the other side, not surprisingly in economics, and we call these, in the case of cities, congestion costs. And so economically efficient urban scale, in a specific sense from the point of view of productive efficiency, from the point of view of average cost, these are going to be found where this average cost is at a minimum. And really it depends upon the sector. If it's the textile sector, the minimum efficient scale is far smaller than it is for other sectors, such as the financial sector, for example, which tends to be located in the largest cities in the world usually. And within a country, the largest city in that country. Also, higher capital labor ratios are needed in cities just because of the infrastructure involved. So that one would first tend to associate this with higher income countries, more capital abundant countries. And you might expect smaller cities as a result to be found in labor intensive activities in developing countries. This is actually not what we find, especially not recently. So as a result, there can be some distortion in markets that are often called urban bias. There can be general urban bias, and then there can be particular kinds as well. So cities are capital intensive. So once again, you can expect to find these in developed countries. There's many dimensions to this. Some of them are not quite so obvious, but in order to concentrate economic activity, of course you have to have taller buildings, but it's underappreciated. One of the costs of building taller buildings is just the increasing share of the square meters that have to be dedicated to elevator space. You know, you have to put your transportation systems more underground, you have to put your electrical grid more underground. So it just is it's a much more expensive proposition, which is paid for by the higher productivity that's possible in economic development. So urbanization in developing countries has taken place then at an unexpectedly rapid pace. And that's what we saw in the stylized facts. And there's been huge informal sectors, as we've been calling it. You saw a picture perhaps of one earlier in an earlier slide. They have different names depending upon the country, favelas in Brazil, shanty towns, and so on. But a large fraction of the workers who live in these informal areas are outside of the regulated labor market. Many of the firms that employ them may not be registered, for example. Also, a majority of growth is in mid-sized cities, but urban bias is nonetheless a potentially serious problem in developing countries. And just as a note, some systemic urban bias in government or government incentivized allocation of investment in first cities or other very large cities can be a particular problem. So the result could be what's sometimes called first city bias. This favors the largest city, sometimes described as urban giantism. And so these have different causes. One of them can be import substitution industrialization, a strategy often used in developing countries in the past, in which one sets up some barriers to trade, such as high tariffs or other barriers, in the hopes that as a result it will become profitable for your own homegrown industries to produce in these areas that otherwise would be not competitive because of the lower price of imports. And then the idea is that one hopes that with learning by doing, these costs for your firms will fall. And of course that's the question, does that happen or not? Often not. If it does happen, what are the mechanisms that would make that possible? That's the subject of a later chapter. Nonetheless, when there is import substitution industrialization, there's much more incentive, in fact a great deal of incentive, to concentrate in the largest city, particularly though not only to avoid transportation costs. And so you can see this in some countries. Import substitution is put into place in the past, 1960s, 1970s, for example, a lot of concentration in the largest city. The country may then liberalize, and you see more economic activity closer to the borders more generally. So that's one possible cause. Another is the bread and circuses effect. That is to say, try to take care of the people in your cities so that they are happy and are not likely to support a coup or revolution against you. And this is to prevent unrest. But the result, of course, is that it attracts more and more people to come into the city to take advantage of the bread and the circuses. So some evidence of this is that a comparison of stable democracies in relation to unstable dictatorships. The latter tend to have a much greater concentration of the population in general, but the urban population in particular in the largest city. Another is the result of a hub and spoke transportation system that may, of course, stem from a colonial period in which resources were exported from the country without much internal development, but nonetheless in relationship to more of a transportation web. A transportation web would make it lower cost for some of the smaller cities to participate effectively economically. And then finally, compounding this is the effect of locating the national capital in the largest city. And so this together can be seen as part of the picture of how developing country cities have become more urbanized, perhaps more quickly than economic efficiency would provide for. And some of what has become the argument that there should be some policies in place that put some more limits on rural to urban migration incentives, quite possibly centered on improving institutions in rural areas. So with that, on the next episode, we'll look in detail at the analysis of rural to urban migration in developing countries. Thank you.